Today, folks, an opportunity of a lifetime is presenting itself to you when it comes to these Canadian banks. If you're looking for dividends, look no farther. This is not financial advice. This is just one clown's opinion on something that I just don't think is nearly as catastrophic as the whole world is making it out to be, and that is the macroeconomic circumstance of these higher interest rates. Are they really impairing loans? Are we seeing destruction and the financial banks are going to collapse, considering the two largest companies in Canada are Royal Bank and TD, and those are the two banks we're looking at today with their recent earnings. Consider hitting that like button. And the reason I'm claiming this to be an opportunity of a lifetime is if we just look at the dividend yield on Toronto Dominion Bank, there has been no other time in history except for one when the yield right now sits at 4.7%. You know, the only other time that was during the pandemic. Outside of the pandemic, even the 2008 financial crisis, TD's dividend never reached over 4.5%. Hell, even during the dot-com era, the highest the yield got, like, can we even go farther back than that? Yeah, when was the last time? It almost touched it back during the dot-com bubble, but didn't quite get there. This is one of the highest yield percentages we've seen in TD in literal historic times. Just zooming out a little bit here, year to date, it's trading about 6.47% off the year to date high, and it's trading down pretty dramatically, almost a quarter. It's lost a quarter of its market cap value from the peak of 2022. And again, this is just one of these banks that I have personally been buying. I've loaded up on these banks last month. I'll show you the positions here, doing pretty good on most of them. But let's get into this because first and foremost, from the dividend standpoint, I mean, going from 39 cents 10 years ago to today where they've doubled it, sitting at 96 cents. I mean, we're talking about not only a super high starting yield, but I think they have the capability to still double it in the next decade because their payout ratio is like 46%. And it's going to continue to go up as soon as they stop putting loan loss provisions aside because, as mentioned, net interest income has been hitting records. Look at this. I can't get over this. Total revenue here sitting at $12.7 billion from this time last year when they were getting, $10 billion. On the thing that'll blow your mind the most, look at the year-to-date total revenue here. $37 billion versus $33 billion. Again, $49 billion on the full year, 49 versus 42. These growth rates are absolutely astounding. Now, the net income is actually starting to nominalize a little bit, but the problem is, these provision for credit losses are still hitting the bottom line. So we're seeing the EPS here actually fall off. The diluted was sitting at $1.99. The basic earnings reported was $1.57, which is down from, I think, $1.76 this time last year. So again, they're not seeing the craziest growth. Royal Bank's in a much better position for managing the provision for credit losses and actually managing some growth by firing and laying off employees. But taking a look at the fundamentals, the actual underlying Canadian right now, Canadian card trends have continued to go down. So this is like the debit spend and the credit card spend. Both of these have actually continued to decline roughly since 2021, just showing how the interest rates have been impacting people's spending. U.S. business banking line of credits, however, still going up. So a lot of businesses still seeing some resilience there. And what's really intriguing is the investing average trades. So on TD Direct Investing, if you take a look, it actually declined pretty dramatically on the average use here coming out of Q3 of 2021. And now it's starting to go back up. And the only reason it can be going back up is because people are stupid. They do the inverse of what they should do, which is be more aggressive when the market's down and less aggressive when it's up. But clearly they like buying when the market's going up, not when it's going down. And this is like the true psychological factor we can see within these metrics right here. Taking a look at some of the digital metrics, it's intriguing to think that like McDonald's, like every business, they're all digitalizing, and I cash checks through my phone. I've seen the banks start getting rid of their brick and mortar. I mean, we're seeing the decline of literal brick and mortar bank stores as they try and increase margin, and I mean, it's growing at double digits, people using the mobile aspect of it. Taking a look here though, revenues, actually doing pretty good, 17% year over year increase. Net income, again, seeing a bit of a decline here, down 8% year over year. All in all though, these numbers are very, very good. And I want to kind of break this down in bits and pieces. Actually, before we go into provision for credit losses, take a look at this. Canadian personal and commercial banking was up 7% year over year and up quarter over quarter. U.S. retail up 10% year over year. Wealth management up 1%, finally, because people are gambling and speculating again. Wholesale banking up 46%. I don't know what is going on with wholesale banking, but it is absolutely astounding that they got one vector that's growing, just like Royal Bank. I think Royal Bank, it's more in the insurance side of their business. But taking a look here, it says that impaired provision for credit losses quarter over quarter increased, largely reflected in the commercial lending portfolios across varying industries. These are impaired loans that have lost credit quality. It's not that great. This is a problem, but it's not as big of a problem as I think the market's making it out to be because we have mass immigration. We're always kind of getting cushioned by the immigration that's that's flooding into these conglomerates because they're so monopolistic that there's just no other competition. So these big banks benefit the most, and it gives them some cushion with these new signups to deal with some of the impaired credit, provision for credit losses, because the impairment has pretty much been doubling on almost every aspect of every business. But that's where we're currently sitting at for TD. Now, Royal Bank, again, Royal Bank is going to be more stable, more resilient. I don't think the dividend is at a 20-year, high, something we haven't seen since the pandemic. But the dividend yield is still historically high at 4.42%. Been a bit of a better performance, only down 4.6 year to date from the 2022 peak here. It's only down 17%, so a little bit more stabilization. But this is why you want to load up on the biggest companies. It's like if you just bought Apple, if you just bought Royal Bank, if you just picked these high quality companies over the last 5 years, you've done very well. Royal Bank going from 60 cents to $1.35, over doubling of the dividend. They're taking advantage of layoffs. The layoff thing, I think, is something we're going to continue to see. It'll be a common story because shareholders matter more than employees. So obviously when net income and EPS is getting hit, the first thing they're going to do is look for the fat. They're going to trim the fat. And then when we get out of this more unstable market into a more nominal market and things start to level out, they start bringing interest rates down. That's when this becomes a well-oiled machine because they've refined it in the tougher market environment, right? And again, I think interest rates will probably nominalize between 3 and 4%. It's going to hinder the revenue again because the revenue is only going up because net interest income is skyrocketing. If they bring it down, we will see the revenue come down probably a bit. But again, they're going to benefit because it'll finally be hitting the EPS and they can shake out some of these loan loss provisions. But they revealed that the profits increased $295 million to $3.9 billion as just about all divisions of the bank's multifaceted business showed growth. And let's take a look at that because first and foremost, net income, $3.87 billion. There it is. Actually up year over year, which is very nice. But on a 9-month end, we're sitting at $10.7 billion versus $11.9. So we're down about $1 billion. Provision for credit losses $616 million, up dramatically year over year. On the 9-month, $1.7 billion put aside versus $100 million. Could you imagine if they could hit that on the bottom line? If they could just add that to their net income, I mean, this bank would be at an all-time high right now. I don't think people can appreciate that enough, and I think that's an inevitability that is coming. Taking a look at all aspects of their business, P&C up 5% quarter over quarter, 6% year over year. Wealth management's up 10% year over year, doing a little better actually, but on a quarter over quarter basis unchanged. Capital markets up 43% year over year, just absolutely crushing it from last year. Again, that's probably coming out of the pandemic and some of the more intriguing market aspects of the macroeconomics. But taking a look at insurance, up 50% year over year, absolutely crushing it, 30% quarter over quarter. Again, a lot of aspects of their business doing exceptionally well here. Taking a look at the solid average loan growth, and again, I love the way they say solid because it's weird that everyone's expecting some implosion, some massive economic bubble deflationary period. And it's not what we're seeing. We're seeing continued loan growth. I just took out a loan to purchase our property from TD. TD's taking advantage of that. So, I mean, if loan growth was declining, that would really show troubling times. But loans are going up across all segments. I mean, we're seeing consumers just being fairly strong here. Yeah, they're going to cut back on some things. But, when we take a look at basically Canadian banking average loans, those are probably more personal, are up. Canadian banking average deposits are up. What else is in here? Wealth management, up. U.S. wealth management is up. Capital market loans and markets. This one actually, it's up 13% year over year. Everything is up. This is like the blue sky opportunity of a lifetime, in my opinion. If you're looking, again, we're not going to talk about I don't want to put it out there that, Royal Bank or TD are just going to jump 20% for whatever godly reason because they're that undervalued. They could. But I think that if you're looking for 3, 5, or 10 years out from now, not only are you going to lock in a super high yield, not only are these banks going to continue to increase the dividends, in my opinion, every single year, maybe not at the rate they were, but they still have bleed room to probably double it easily, in my opinion, especially when the market nominalizes and they can capitalize on the higher interest rates. Everything I look at here says, why aren't people buying these? I am. What are you doing?